the building, did the building have any,
You want to turn it off for a minute? Here, hang on. Just that second button.
right there?
Or the second, that one.
Hey, Jim. I've read. It's 10 o'clock. Let's go ahead and get started. Call the meeting to order. First, we have a presentation by one of our fixed income people. We have 30 minutes total, so we'll go 20 minutes for the presentation and allow 10 minutes for any questions. So go ahead.
All right, good morning, everyone. Thank you for inviting us here to meet with you all today, and thank you for entrusting us with your fixed income portfolio. It's actually been a year almost to the date since we presented in the finals presentation last year on July 9th. So some brief introductions. Here with us today is my colleague Peter Taggart, and I'm Kate Strengfeld. We're on the client-facing team at PGIM Fixed Income, and we work with our large institutional clients. So starting on page 4, as you may recall, PGIM Fixed Income is a large and well-resourced fixed income asset manager. We have over 200 fundamental credit research analysts, and their job is to source the best investment ideas for the senior portfolio managers. And they're located around the world and broken up by sector, as we can see from the pie chart in the middle of the page. I'd also like to point out the pie chart at the top right of the page. We manage the majority of our assets for third-party institutional clients like yourself, but we also manage a large portion for our insurance company parent, Prudential Financial, the proprietary assets. And one thing we like to note is there is an alignment of interest as we use the same investment tools and research process for our insurance company parent as we do for portfolios like yours. So if there are any questions on the firm, I'd like to hand it over to Peter. And if we could move on to page 8, please, Regina.
Yeah, let me add my thanks. Thanks so much. And on page 8, you can see this is your senior investment team. A year ago, tomorrow will be July 9th, Rich Picarillo and I joined you all on a Zoom conference call. Thank you very much for giving us the opportunity to work with you. And I will point out that there have been no major changes. We did add one person in agency mortgages. Sydney Zhu joined us earlier this year, adding to our capability in that area. But there are no other changes to our investment team. So a very stable team, and that's one thing that we do hang our hat on at PGIM Fixed Income is a stable organization. We think that's important for you because that leads to a stable investment process as well. So Regina, if we could, we'll turn to page 10. and we'll get right to the punchline. This is the performance. Thank you for investing with us and giving us the opportunity. You've invested in our absolute return strategy. The finals, as we mentioned, was just almost exactly a year ago in July, and you funded the portfolio investment on August 10th, 2020. We're showing you a variety of different cross-sections of time here, and I'll walk through the numbers. We don't have the ability to look at attribution of performance on the exact day that you invested. So we are showing some performance here for attribution purposes, so we can show you what worked, what didn't, what made money, what lost a few basis points. And that'll be the September 1 to May 31 time period. We just yesterday got the June numbers, and if you want to write these down, you're welcome to do that. Otherwise, I think the report already went to Regina and the staff. But in June, so this is all as of May 31st. In June, your portfolio was up 0.67%. For those of you who may not be bond geeks as we are, we call that 67 basis points equals 0.67. There are 100 basis points in 1%, and so we tend to talk in basis points because saying point every time you want to say something just takes a lot of time. So your portfolio is up 0.67% in June, or 67 basis points. Your benchmark, which is LIBOR, a cash index, was up 1. That brings your year-to-date return to 68 basis points positive, in other words, 0.68%. And the benchmark was up 10 basis points, or 0.1%. Since inception, in August, since August 10th when you invested, your portfolio is up 3.15%, and the benchmark is up 0.2. So we've generated a positive return for you since inception through June 30. And again, that's not the numbers showing here because we just got those numbers yesterday after we had to ship the books to you. So you're up 3.15%. Let's see, the only other thing I'll mention is the Barclays Aggregate Bond Index, which I believe is the fixed income policy benchmark for your pension fund, was down 1.6%, had a return of minus 1.6% year to date so far in 2021. So interest rates have been volatile. I'll talk about that in just a minute. And I think what we're going to do in the following pages is focus in on that 279 basis points, or 2.79% incremental performance that we've generated over and above the cash benchmark since the 1st of September, which is the closest we can come to the time period that you actually invested. But I think it's representative. So Regina, if we could turn to page 11, we'll talk about interest rates. Fixed income investments are subject to fluctuations in interest rates, as you may be aware, and we've had a lot of variability in that. So I'll point out, you can see it graphically, and you can also see the numbers. So why don't we start with the graph at the bottom left that's called U.S. Treasury Yield Curve. And a yield curve is nothing more than the yields for various Treasury maturities. You can see the yields on the left, on the y-axis. You can see the maturities along the x-axis. And I'll point out a couple of data points. You can see all the data in the chart above, but I think looking at the graph is interesting and helpful. So at the end of 2020, that's the blue line, the 10-year Treasury, which is a pretty representative and commonly referred to benchmark in bond land, had a yield of 0.92%, or 92 basis points. At the end of May 31st, which is where we've cut all the data for this for today's discussion, the 10-year Treasury was at 1.6, and I'll just mention that it peaked at 1.7. Today, we just talked to one of our portfolio managers, Mike Collins, a few minutes ago, and he said the 10-year Treasury hit a recent low of 1.25%. So as you can see, if you wanted to do a little asterisk or a dot between the 0.92 and the 1.6, in other words, between the blue line and the yellow line, it hit 1.25, and just before we came into the meeting, it was at 1.28. We actually think that interest rates are going to remain low and range-bound. We're not concerned with a rise in interest rates. While interest rates seem low to us in this country, interest rates are a lot lower in most of the European countries, in Japan, most of the developed world. And we have lots of investors coming to us and other money managers looking for assistance in generating higher levels of return than they can generate in their home countries. And so that creates a demand pull on interest rates that's going to keep it low. There certainly is inflation. It's been in the headlines, but it seems to be leveling off. And a lot of that, in our opinion, seems to be because of this sort of repricing of the recovery, which is happening, wow, really quickly. This is my first business trip in 14 months. We're happy to be here, but I actually didn't think that I would be requested by a client to come and visit until maybe August or September. So it is starting. I don't know if anyone has been on an airplane. It's hard to get seats on an airplane. It's hard to get rental cars. It's hard to get your pick of a hotel. Plenty of hotels available, but it may not be where you want to be. And so commodities, autos, lumber have risen a lot over the last year, and in recent months in particular, as everyone's buying stuff. And now everybody's going places. They're going to restaurants. And so there certainly is inflation, but we think it'll be transitory, and we think that it will slow down at some point because a lot of these prices are starting to level. And if they stay level for the next year, well, that's zero inflation. So yes, overall, we have had inflation, but we think that that's going to be transitory, and we think that supports lower rates. So as that relates to your portfolio, the first quarter was not a good quarter, and in fact through May, because of that interest rates. And actually, if we look at, hold that thought just for 1 minute. I just want to show you on page 12, Regina, if you wouldn't mind turning us there. So we have the rates, interest rates, which drive bond prices, but we also have what we call spreads, or the yield that a corporate bond or an asset-backed security or some bond is over and above U.S. Treasuries. That's what we call the spread. And so as spreads compress and become tighter, because we're in a really good market for fundamentals, for growth assets like stocks and like bonds, those spreads over Treasuries have compressed, have tightened, and as they tighten, that boosts the return. So if you look at the rightmost column, this is year-to-date 2021. Again, the numbers in the book are as of May 31. I'll just highlight a few things that are prevalent in your portfolio. The fourth line down is BBB corporate bonds. We like BBB corporate bonds a lot, and the return in that sector has been 2% year-to-date through the end of May. If you look to about the midpoint, you can see B single A U.S. high yield. That's double B high yield. And double B high yield, which is in your portfolio, has had a return of 285 basis points, or again, 2.85%. AAA CLOs. A CLO is a package of loans, bank loans, that are packaged together, which makes it really easy to invest in, and also we're able to generate a higher credit quality by having somebody else take the loss concern piece. So those are up 59 basis points, or a little over 0.5% year-to-date. And then commercial mortgage-backed securities toward the bottom, that's the CMBS. We invest in both investment-grade and AAA-rated commercial mortgage-backed securities in your portfolio, and you can see that those have had returns of between 94 and 144 basis points. So with that as sort of background, Regina, if we could turn to page 13, we'll sort of show you the summary here, which is this is the attribution. In other words, how we've done, where we've made money, what's worked and what hasn't, again, through May 31st. And what I can tell you is that the biggest challenge, the biggest headwind we've had, as you can see right at the top of page 13 here, is duration, which is sensitivity to interest rates, and yield curve, which is how we're positioned. Remember those yield curves that we looked at earlier on one of those first pages, the blue and the gold. As those curves move, which they do from time to time, we can take advantage of that. So our positioning, expecting lower rates generally to remain stable, did not work in the first quarter. It did not work through May, but in June and July, it's actually recovering quite a bit, as you know, because I mentioned what the June returns have been. And so far, we're up a bit here in July, as you might expect, because I mentioned that interest rates have continued to fall. So I think the story's a really good one. But despite the headwind of the interest rate positioning, you can see the fourth line down is sector allocation. That's the dark gray. We've earned almost 3.5% for your portfolio from our positioning in sectors. And then the other gray towards the bottom is security selection. By owning the right bonds in each of those sectors, we've earned another 173 basis points for you, almost 2%. So let me just hit some of the numbers there. I mentioned commercial-backed mortgages, commercial mortgage-backed securities, which are the CMBS, and I mentioned the collateralized loan obligations, the CLOs. If you just take a look at those under sector allocation, you'll see that we added 16 basis points of return through our ownership of CMBS in your fund, and 52 basis points, or just over 0.5% of return from the fact that we owned CLOs. If you go down to the bottom, to the security selection, you'll see that because of the bottom-up fundamental research, Kate mentioned that we have 200 researchers located around the world, we were able to buy the right CMBS. So we added another 35 basis points. That's the line under security selection for CMBS, from owning the right bonds that performed better than the CMBS market did. And in CLOs, we bought the right CLOs that performed better than the CLO market generally. You can see it again in high yield. You all are no stranger to energy here in Oklahoma City, and energy was part of what we own in high yield. So if you look under sector allocation towards the top, we added 1.7% or 170 basis points from our positioning in high yield bonds by owning high yield bonds. And then down at the bottom, we added another 14 basis points by owning the right kind of high yield bonds. So there's a lot of bottom-up fundamental research that's going on day to day across hundreds of securities that are in your portfolio to make sure that not only is our sector positioning correct in the way we want it to be, but they're also investing in the bonds that we think are going to have good fundamental value and as well an opportunity for good relative value as well.
Peter, can I just
Yes.
ask a question for clarification? So the attribution is really relative to a return objective, not a benchmark that has any securities in it.
So it's relative to LIBOR. Thanks for asking. So it's relative to their benchmark, which
Right.
is the 3-month LIBOR.
But there's no
credit in
credit or
these sectors are not there.
It's from a duration standpoint. You said long duration. So
Yes.
it's longer. The portfolio has longer duration than the LIBOR.
That is
return
correct.
benchmark, but relative to an aggregate benchmark.
It would be shorter. So I'll show you these numbers in a couple of pages, but let me just reference that, and thanks, Jason, for asking. So the benchmark is 3-month LIBOR. Its duration is a quarter of a year, 3 months. Our positioning as of the end of May was a duration of, we call it in years, 1.4 years. It's sort of funny that we call it in years. It relates in a way to maturity, as you and I know, but it's really designed not to talk about maturity, but how much interest rate sensitivity the portfolio has. So we are long duration at 1.4 in the portfolio relative to the benchmark of 0.25.
But relative to
And
the
the
policy
Barclays-
benchmark,
Barclays
for the
Ag,
overall fixed income, it's
much
lower,
shorter. What would
much
the,
lower interest rate risk.
I don't know off the top of my head what that duration is, but wouldn't it be
It's
around
about
5,
It's
6,
closer to 6.
6 years? So call it 6 years, and we're at 1.4. Yeah.
Thank you.
Does that help?
Just trying to clarify. 'Cause
Yeah, thank you. Thanks for the context. That's really helpful. So, so anyway, that's what we've done so far through the end of May. The good news is that those numbers at the top for duration and curve in June and so far in July, just a few days into July, are turning positive. So we now, that is no longer, that interest rate movement is no longer a headwind, but has become a tailwind as we expected. And I would encourage you, please don't look at performance, every month, I mean, we all look at it, right? But we're really trying to invest your fixed income assets as a pension fund with long duration objectives. We're trying to invest, over an investment horizon of 2, 3, 5 years. So we had a little bit of a hiccup in the first quarter there. I think just 2 more pages, and I'll wrap up. So page 14, if you could, Regina, is the attribution looking at the bottom up. And I know you guys are going to ask me a question on something on here. But what we show is the top 10 contributors by industry that were positive on the top left. So energy, a variety of different forms of energy you'll see on that list. Those were sectors that performed very well. You can see energy upstream. We actually added 42.47 basis points during this period just from that particular sector weighting. You can see the things that hurt us, that were detractors down at the bottom: cable, satellite, telecom, building materials, banking. Those were all detractors. You'll notice the numbers are small, 2, 4, 5, 6, 8 basis points. In the context of generating a 3% or so return, 8 basis points is not a big deal. We do a lot of, again, fundamental credit research from the bottom up, looking for the right companies and looking for the right sectors. You'll see the top 10 contributors by issuer on the right. Energy was one of those. Anyone want me to talk about the first one, Chesapeake Energy?
Never heard of them.
The hometown team. So we invested in Chesapeake in December 2019. Sadly, we were a little early. In 2020 with COVID, they sought bankruptcy. We led a team of investors because we were an investor in Chesapeake Energy's bank loans at that time. We led an investor team to help restructure the company. In mid-2020, we helped them enter and exit from bankruptcy very, very quickly, which I think is often a very good thing. We also brought $600 million in new investment capital from PGIM Fixed Income and our clients to that seat at the table. And so we were able to get through the restructuring very quickly. We negotiated a deal that worked for all of the people in the capital structure, from the most senior bank lending down to the equity owners. I think the equity owners weren't as happy as they might have been if they had not gone into bankruptcy. But we think that I think it was April, May, June of 2020 was a really good entry point for us to invest $600 million. I should mention also that our outlook for natural gas is actually quite optimistic, and so Chesapeake provided us with an excellent way to put that trade on and to participate in our outlook for natural gas. So it's been a great return. It's been one of the great return stories of your portfolio over the last 6 months or so, and we think that will continue to be a strong one. Another one on here related is Feral Gas, about halfway down. And you can see it's fairly, once you get past Chesapeake that added 22 basis points, it's fairly distributed and diversified, which is what we're looking for. That's why we have all the analysts looking at all these ideas, building a portfolio of several hundred bonds. We want it to be diversified because that'll give you good, strong returns and stable returns over time. And then finally, it's not on here, but as we were talking with one of the senior portfolio managers this morning, he said, don't forget to mention Stonegate, which is not on the top 10 currently, but I think maybe the next time we talk. He said it's an owner and manager of UK pubs, and apparently the Brits are very happy to be out at their pubs again, and so the Stonegate UK pub company is also providing some really strong performance, although not in this particular time period. I think it's more recent, like May, June, July. Okay, one more page, Regina, page 15. This is the positioning of the portfolio as of May 31st. You can see some general characteristics at the top. You can see Jason's question earlier about duration. That's the third line down. That's the measure of sensitivity to interest rates. You can see your benchmark, a 0.25 year. We call it years. I'm not sure why we call it years. It's historical, I guess. It's based on maturity, but it really, the reason for it is to measure the sensitivity of bond prices to interest rate movements. Your portfolio, 1.4-year duration, and of course, as we talked about, the Barclays Ag is about 6. So you're shorter, and this is providing a less volatile way to participate in fixed income markets as part of your fixed income allocation. Number of issues, 283, several hundred, as I mentioned. And maybe I'll just hit on some key themes here. You can see the allocations we have to CMBS on the left, the sector distribution, commercial mortgage-backed securities, 12%. CLOs, collateral, anything that has an acronym like that is generally what we call a asset-backed security or structured product. And I don't know why we talk in code, but we do. So CMBS are commercial mortgage-backed securities. CLOs is secret code for collateralized loan obligations. These are the packages of loans that are put together and then we can buy the whole package. Asset-backed securities are boring things like credit card receivables and car loans and things like that that we tend to think are very good value and very high credit quality. You'll notice that the portfolio has a lot of AAA securities. Those are the highest rated securities on the right, and that's because a lot of these CMBS, CLOs, and asset-backed securities tend to be very high in quality, AAA rated. So there's a lot of AAA, and that's offset by 14% in BB high yield and a few percent in some lower rated high yield, and you can see those over on the right. So I think I'll stop there. I think I've given you a good overview, and I'm sure you have questions and would be happy to answer any.
Okay, questions? Doesn't appear so. Thank you very much.
Thank you. It's great to see you all. Invite us back again, and we'll look forward to giving you an update on Chesapeake the next time, as well as what the Brits are doing in the UK pubs.
Mr. Chairman.
Thank
Thanks.
you.
Have a great day. Thank you.
Mr. Chairman. Mr. Chairman. I'm sorry, I didn't understand we were at the end of the presentation. I did have a couple
Okay,
of
go
quick
ahead.
questions, if I may.
Yes, please.
Thank you. Well, first of all, thank you for a very good presentation. As a new member on the board, it was very insightful to hear what you had to say on there. We don't have a lot of time, so I just have a few just brief questions, not necessarily about rates and all those returns and those things. But I did notice on your slide number 4, there was the last bullet point on there had a reference to ESG factors.
Yes.
And I recently attended a national conference of public employee retirement systems, primarily for new trustees. And there was a presentation on there about ESG, where a gentleman talked a little bit about it. And then there was the final presentation was about some attorneys who talked about fiduciary duties. And I would just like to maybe have 3 really quick questions about that, if I could kind of unpack that last bullet on there.
Yes, please.
First question would be, what are your ESG factors? And I don't expect you in this short amount of time to tell me everything about it, but if you could just give me kind of a brief description of that.
Sure. Off the top of my head, I am not certain what the specific factors are, but I can tell you that every bond that we research, one of the jobs of the fundamental research analyst is to assess ESG factors, environmental, social, and governance factors, and put those into the rating. We do rate every bond that we buy by ourselves, so it's interesting to look at S&P and Moody's, but we do provide a PGIM fixed income rating as well, and sometimes those are different. Kate, I don't know if off the top of your head you know what some of the factors are?
I do not, but
Okay.
it's the same analyst assigning the ESG rating as the credit rating. So they're marrying the two.
This is not an ESG specific mandate, correct?
This is not an ESG specific mandate. We do have ESG funds and investment strategies, which would take what we're doing for you and just provide an overlay where the fund, the ESG ratings take more prominence in the decisions that we're making. So we make note of them on every bond. I'm sorry I can't answer the question about which the factors are. We could follow up with that. If
Okay.
that would be helpful.
I don't think that's necessary. Really the other questions that I had did somewhat drill into that a little bit more. I was interested in knowing how that gets integrated into your fundamental analysis. And I think as it mentioned here, how you have a proprietary ESG impact rating framework, but this probably isn't the place for that.
Well, I can give you some generalities, and maybe
Okay.
it would be helpful if we send to Regina as a follow-up some information about generally our ESG process. So ESG is important to us as bond investors. We're buying companies. Often some of the biggest issuers are manufacturing companies. And some of them that have been around for a while, whether it's an energy company, an auto manufacturer, chemicals and paint manufacturer, they've got some history. And it's important for us as investors in bonds, basically lending that company money for a term of 10 or 20 or maybe 30 years to have an assessment of what the risks are, that maybe there's something under that field over there that we're not thinking about because 20 years from now that might impact their ability to pay us back. So ESG considerations, environmental considerations in particular, have been part of our evaluation, fundamental evaluation of corporate credits for years. It's become more formalized as the world has become much more interested in those letters E, S, and G in recent years. So we're a signatory to the United Nations PRI, Principles of Responsible Investing Treaty. I think we signed on to that in 2014. We've been considering environmental, social, and governance issues in our bond ratings that we do ourselves for years. And what's new in the past couple of years, we've started to assign for every bond and every issuer a rating that's focused on how good they are with regard to ESG, so that for clients that are interested in that, we can then do a screening and make sure that their portfolios would eliminate someone that had poor ESG.
And I appreciate
So
that.
hopefully that's helpful.
And just for clarity, the purpose I bring this up is that as I look into it, I learn about it, it is somewhat controversial. And it doesn't look like there is, direction one way or another on this. In one administration, Department of Labor says for pension funds, do not use this as your benchmark. But now we have a new administration here saying, well, we're going to remove that, but we're undecided on what you do. So there's not a lot of guidance there, but in that same conference, there were some attorneys that talked about fiduciary duties and how to do things so attorneys can sleep well at night. We're somewhat lukewarm on this concept. And, but the one summary that I got out of there is for fiduciaries, look at your policies. Write a policy, look at your policy, follow your policies. And I think that this is a good thing, probably in the future, that this board take a look at our policies to see where we're at on this issue, and just make sure that we are following, that our policies are what we intend and that we're following what we have in there.
Well, as I'm sure your consultant would say, that's always important to follow your policies and to make sure that they're reviewed and appropriate. I can tell you quickly that we're seeing more adoption and interest in the ESG framework outside of the U.S. So our European clients and our Asian clients in particular are quite keen on it, quite interested in it. We're seeing a very mixed level of interest across the U.S. Some other states like California, as you might not be surprised to hear, are very interested in ESG, and it comes up at many meetings. And other locations are less interested. But again, we can accommodate the needs of our clients, as different and disparate as they may be, because ESG is something, as bond owners, we've got to look at it. We've got to know what the risks of this company are. And even if we're not going to have some sort of ESG mandate or policy with a particular client, we have to know what those risks are. If we're going to, basically, bond investing is lending a company or some entity money, and the real key to it is getting your money back, right? And you collect a nice coupon along the way, but you got to get your money back first. And so the environmental in particular, but all of the ESG considerations have to be taken into account to know, is this the right price for this bond and the right yield, given what the risks may be 20 years from now?
Yeah.
So thank you for the question.
Well, thank you for your answers, and thank you for a very good presentation.
Thank you. And why don't we send to Regina, and you can circulate as appropriate, some information about what we do in ESG, and if there are further questions, let us know.
That'd be perfect. Thank you.
Any
That's
other
all I
questions,
have.
sir?
Any other questions, trustees? Okay, thank you very much.
Yes, thank you again for investing with us, and thanks for your time today. Have a great day.
Okay, time to move on. Next is the approval of the minutes for the meeting of June the 10th.
Mr. Chairman, I have a small correction. I am not listed as attending the meeting in the first summary. Could we move approval with that change?
Okay. Trustee Thurman, is that fine? Yes. Okay, is there a second? Time for the vote. Okay, the motion passed. Next item is number 4, the consent docket. Reported judgments for the month of June 21. Do I hear a motion? Please record your vote. Okay, the motion passed. Next item would be ratify approval for several items here. We have record your vote. Motion passed. Let's see, got to get the screen up here a little bit. Ratify approval for the next items. Please record your vote. Item passed. Are we on B? Okay, B, payment for claims. I'm sorry.
We're on 7.
Excuse me, on number 7, approve the following applications for service retirement. Let's see, there are one. Do we have a motion? We have a second. Please record your vote. Motion passed. Okay, we're on item 8. 3 items. Please record your vote. Item passed.
There's quite a way, so you can keep scrolling up.
Keep scrolling up.
Give it a 9. There you go.
Okay, item number 9, receive report of death. There's one item. Record your vote.
And that one's done.
The item passed. Let's see, next is we'll receive an investment from our investment consultant. And also, Jason, would you have anything to say about the ESG investing?
The manager and where, how it fits in the portfolio, and I'll talk about ESG.
Okay.
Just briefly. So if you have our report in front of you, and on the first page is the asset allocation and where you are relative to targets. I just want to lift the conversation up to the strategic allocation. You have a 65% target to equities overall. Equities are, as a long-term investor with long-term liabilities that needs to get a 7% plus return over a long period of time, you have to take risk in the portfolio with riskier assets to drive return. That said, we recognize that equities go up and down and can be quite volatile. The last year and a half, we've certainly seen that with the onset of the pandemic in February and March of 2020. You saw equities down close to 50%. At that time, bonds provided some protection. You have a 20% strategic allocation to bonds. Bonds overall are designed to provide some income to the portfolio, provide principal protection, and limit volatility. We know in the short term, bonds can be somewhat volatile, but relative to equities, a lot less volatile. And then the third major bucket that you have is real assets or real estate, and you have a 15% target there. The strategic purpose of real estate is to provide a hedge against inflation, a premium return to fixed income in a low yield environment, but less risk than equities. Within the fixed income, and I think this is important, we have the 20% allocation. We have been, over the last really 10 years, or 13 years, a very low yield environment, and it's gotten lower. Overall, we can't abandon bonds because of the importance in protecting principal and mitigating volatility. So we have some different components within the bond portfolio. The core bond allocation, small 3% allocation on a strategic basis, is to an index fund, U.S. investment grade only. I'd say that's primarily to provide exposure to the bond market, very low cost, and liquidity. It's easy to move in and out of that on a daily basis for rebalancing and for your cash needs. The Core Plus allocation is the anchor or the foundation. Core Plus is going to have a duration generally similar to the U.S. investment grade bond market, or the aggregate, the Bloomberg Barclays aggregate. So you're going to have about a 5.5 to 6 year duration. With that duration, you can have a little bit more volatility. The more interest rate sensitivity, the more volatile the portfolio can be. But that strategy is implemented by Western Asset Management, and they have the ability on an opportunistic basis to add some high yield, to add some non-U.S. and emerging market debt, but they're going to generally stick to the duration of the benchmark. The third component, or third of really four primary components, is the absolute return. This you've had for some time, going back to the mid-2000, probably 2004, 2005, and you implemented this through a hedge fund-to-fund strategy, PAMCO, that had higher fees, a little bit less liquidity, meaning quarterly liquidity, and the potential that when you were trying to get out, you could have some lockups because they were investing in less liquid securities. Some of that could have been, they were relative value hedge fund strategies, merger arb, distressed. It's a little bit more complicated and a little bit higher fee structure. In 2019, a year ago, we pivoted there and added the PGIM strategy that you heard from today. We would describe it as the name of the strategy is, it's a liquid absolute return strategy. So it's really investing in traditional fixed income securities, U.S. Treasuries, other foreign national bonds, can invest in U.S. corporates, both investment grade and below investment grade, and as you saw, structured product, asset-backed, CLOs, CMOs. It really is a benchmark unconstrained strategy. That's what absolute return means. They're trying to eke out 50 basis points to 100 basis points over time and just eke out a positive return each month, really unconstrained to any benchmark. It fits in the portfolio as a fixed income strategy that's going to be less sensitive to interest rate movements and have greater drivers of return through other mechanisms or other levers, through security selection and credit. From a return objective standpoint, the stated objective for the strategy is LIBOR, which is a London interbank rate, plus 3%. So it's not really a benchmark, it's a return objective. What we're looking at is how is that doing relative to the aggregate, the broad U.S. investment grade market. Are we getting a little bit of incremental return from these other levers? Are we taking less interest rate sensitivity? And are we doing it because of the pivot we've made from a hedge fund strategy? Are we getting it in a more liquid, meaning we can get in and out easier, and at a lower cost? It's less than half the cost of the hedge fund strategy. It's really doing what we would expect it to do. I just wanted to clear that up, just because when we're looking at their attribution relative to a LIBOR, that is appropriate. However, how it fits in the portfolio, it's a little bit more, we're thinking at it a little bit more holistically than that. So overall, as we look at that strategy, year to date, it's up 68 basis points, where the aggregate benchmark is down 1.6. So within the context of your overall fixed income, that allocation, while 68 basis points doesn't seem like a lot, it's been very additive relative to the broad overall bond market. So hopefully that helps. Just a few comments on ESG. This is certainly something that you can't turn on the television, go to a conference without hearing people talking about environmental, social, governance factors and issues related to plan sponsors and the like. I think the most important thing for you all to understand is you're certainly implementing your portfolio, and your managers are in compliance with all of your policies. as fiduciaries to a public pension fund like this, first and foremost, your obligation is to do what's in the best interest of the beneficiaries and the plan. And so there is somewhat of a slippery slope for public pension funds to be having explicit objectives outside of that, what's in the best interest of plan participants. Oftentimes, ESG, when it is explicit in a mandate, you're seeing that more where it's either been legislated in public systems. So certain states may have legislated certain things that they want to be the state investments or the whatever entities and investments to be carbon free or to have that. You don't have that here. You do have some restrictions with respect that all U.S. investors have as to investing in certain foreign companies of countries, Sudan, Iraq, North Korea, that you can't do that. Even your managers couldn't do that even if they wanted to. So there is a bit of a slippery slope in explicit mandates. Typically where we see more values-oriented investing is in the not-for-profit space or private entities that do have other explicit mandates. That said, the notion of fundamental-oriented managers evaluating environmental issues or social issues or governance issues around companies or securities that they're investing in is totally appropriate. And you're just hearing them talk about it in a different way, and that's why we would see that language in their material. To not mention it today would indicate, well, they're not thinking about those things. But certainly, fundamental-oriented managers have thought about those things for some time. So we would, if we go through your portfolio, and we do work on all of your managers to understand what they as a firm are doing with respect to environmental, social, governance issues, how that's incorporated into their process. And so we can provide that information to you. I think it's important to note, if you had an explicit mandate, say no firearms, tobacco, or fossil fuels in the portfolio, that would be, that's doing something different, that's explicit. And this is what the DOL is getting at in their opinions, that public pension fund trustees and trustees of pension funds really can't overlay that on their what they're doing, because it's a little bit different. So hopefully that helps a little bit in that discussion. But I think it is important to note we are evaluating that, and your managers are considering those factors, but it's not an explicit mandate to exclude certain things or do certain things intentionally. So overall, again, a positive month. This report is very preliminary. It's because we got it out on the third business day. The long-short equity numbers aren't updated. The real estate numbers aren't updated. So for the month, up 50 basis points, it's probably going to look a little bit better than that. One-year numbers continue to be very strong, up 27% relative to the benchmark, up 24%. Really very strong performance. As I mentioned, last month, we will have some recommendations in the private equity space next month. We intend to come with a couple of recommendations, and then we'd like to continue to bring in managers. There's no manager issues or concerns, but following up in September and October as the agenda allows, to just get back in the routine of having managers come in and just give updates to you if that's appropriate. Any questions? Yes.
I've got a few, not to beat a dead horse with the ESG question. I think first, it's important for us to realize that there's, and I'm sure you guys look at it this way as well, with ESG, there's a very compelling argument to be made that those companies that are more ESG could be more profitable because that's kind of where where a lot of industries are moving. That's where a lot more younger consumers are interested in really purchasing from those companies and stuff like that. So With your ESG, do you guys have, with your portfolio management, do you guys have a specific allocation, target allocation to ESG, or is that just simply a factor in determining if you include those securities in the portfolio?
When you say you guys,
Sorry, when you manage your portfolios.
Well, we don't manage any money, our firm. We're not a money manager, we're a consultant. So each client has different investment policies.
Yeah.
So we work with public pension funds, endowments, foundations, private clients, insurance companies that all have unique strategies. We do have a number of endowment and foundation clients, religious entity clients that have value-based investments that have explicit mandates. In our public pension fund clients, across the board, there are no explicit mandates for ESG or any values-based, unless it would be legislated by state or local ordinance. That said, as I indicated, we are evaluating all managers, and have been for a few years, on what their process involves. So PGIM is an example. They would have another strategy that is an explicit ESG strategy for an investor that was part of their mandate. What we are delving into is what is their process and how are they considering, are they incorporating that or integrating into their process? So I'm not sure that answers your question.
That answers it. I think, this is a question for the board that may, being a new person on the board, just like Marty, coming in and I'm still trying to figure things out. So as a board, I don't know that we've ever had a conversation about the investment policy specifically. I know we bring it up in every single meeting. We go through this report, but I don't know if when that policy was originally established and how often that's revisited. Just out of curiosity.
It's reviewed at least annually, but we've made revisions. I think the last revisions were probably made within the last 2 months.
Okay.
But changing objectives to incorporate social goals or social objectives is not something that has been discussed, and I'm not sure that is is appropriate in the public pension space.
Yeah. No, I think, again, more importantly, my interest in ESG is more towards, can ESG corporations be more profitable than their counterparts? More from a return perspective than a social perspective. I did have a couple more questions. I see that you've got, and again, all of this is straight out of curiosity. So I see there's quite a bit of allocation over target to U.S. large equities. How do you feel about every time you turn on the news, you hear about the overvaluation that's happening that in our large caps. How do you feel about allocating more towards international and just in general, and also with bonds? Completely understand the importance of lowering the volatility in a portfolio. Do you see bonds as almost as a cash alternative to reallocate into equities when the opportunity is there? Obviously, you have to keep a certain bond allocation in the portfolios, but do you see that as a means to quickly get into some opportunistic equities? And then increase that bond allocation as you get rid of other equities that are might be overvalued?
I'll take the first question on large cap. So at the beginning of the year, we reviewed the asset allocation, and we did make some changes to the strategic allocation, lowering fixed income from 25 to 20 and increasing equities from 60 to 65. And within equities, international equity and emerging markets were increased slightly. There was some rebalancing done, but U.S. has continued to run up. The biggest reason why large cap equities are overweight, both large cap and small cap. They've outperformed, but also what's underweight is private equity, because we increased private equity from 5 to 10%. You don't have the ability to move from liquid assets into illiquid assets immediately. But there has been significant commitments made in the private equity space, and so those will be called down over time. The big, where that dispersion is really coming from, and it's, you can see that here, is real estate is underweight by 5.5%, and that overweight is being held in equities and a little bit of cash. You have more cash than normal. We just did last month, the board approved an additional subscription to the Morgan Stanley Prime Fund, which is, we indicated that there's a queue to get in. So you got the subscription in at the end of the second quarter. It's anticipated that will be called, 75% of that will be called by the end of the quarter, so the end of September. So that money is going into real estate.
Okay.
With respect to fixed income being a substitute for cash, we don't really look at it that way. It's fixed income. You don't really have a target allocation to cash. It's a 0% cash is used to pay benefits. This board and other pension funds that we work with and long-term investors with long-term liabilities, we don't try to be tactical and move in and out. We use your operating needs as the mechanism for rebalancing, rather than trying to be very tactical and say, let's move in and out of this asset class into this asset class, because we see opportunity in the short term. And I think that's served the fund well, as evidenced by your 10-year returns of over 9.5% relative to your policy index of about 8.5%, and in about the 15th percentile, as I recall, over the 10-year period. So we're not trying to be tactical in the short term.
Okay. Thank you.
Okay, other questions for Jason? Thank you, Jason.
Thank you.
Wiley, any talk in the Oklahoma legislature about ESG?
Not that I'm aware of. I would be very surprised if they were trying to put limits on the oil and gas industry or anything like that.
Yeah.
So, and I also think that before the board might make a recommendation, but I think the council would have to approve any kind of ESG mandates to be implemented.
Okay. Thank you, Wiley. Any questions of Wiley? Thank you. Okay, any comments from the staff?
Motion to receive.
Oh, receive the investment report. Excuse me, need a motion to receive the investment report? Go ahead and vote. It passed. Okay, Regina?
I was just wanting to remind everybody that the August meeting has been moved because Louise is coming to present the actuary report. And if you did not get a copy of that, I can provide that.
Okay, any other comments by anyone?
Yes, Mr. Chairman. I have a comment to somewhat wrap up my portion of the discussion about ESG, and I appreciate everybody's comments. I think it is an important issue. Sri, as you'd mentioned, that there is a compelling case that some of the proponents of ESG are more profitable. I think that's what we would want to look at, is the profitability and not the movement. If an ESG company can prove that they're more profitable in the way they're doing, why wouldn't we invest in them? I think where I have an issue is where this is being pushed and it becomes a movement. In that training, there was a gentleman there, I won't look up his name, but he was one of the presenters, who showed a document where he had written up, and he sends to corporations that tells them they will either change their board of directors mix or they won't invest with them. And I think that's where we have a problem. I think if we have ESG and you're an individual investor, by all means, you can be as wise or foolish with your money any way that you want. But when we're looking at ourselves as a fiduciary, that's a different thing. Are we here to push a movement, or are we here to protect the assets, the benefits of our beneficiaries? So I just question the wisdom of using the wealth of a pension fund to support a movement. I think we need to be very careful in what we're doing with that we have people that are we responsible to. Again, I say, if it's your own money, do as you want with your own money. But as fiduciaries, I think there's a different obligation with that. That's all I have to say. Thank you.
Okay, thank you.
Marty, I completely agree. I think that's very important to discuss. I think in the last few years, we've all been a little bit more sensitive to movements and things like that. I've been in the investment world since 2009, and just as a private investor before that, but in the actual industry since 2009. And ESG has always been a popular topic. And from the very get-go, I felt like it was more about, more about profitability, at least for the stuff that I hear, because the stuff that I'm reading are, return related instead of movement related. It's been more about, can those companies be more profitable due to less, lawsuit issues and more people frequenting those companies more than those that are not. So I think it's definitely a really interesting topic for us to discuss. And another piece of that is, and I just lost my train of thought, probably the best part of it too. But definitely something that I think we should discuss. I think a lot of people might even find it interesting. Thanks, Marty.
Well, you're welcome. And I think maybe where we have common ground is when we focus on profitability. When we keep in that lane, I think we're together.
Absolutely. I completely agree.
Okay, other comments?
Chair, this is Amy Madera. I just wanted to thank you all. This will be my last board as a trustee, our last board member. It's been an honor serving each of you. And I'll be cheering for me from the sidelines as I move on to my next organization. But I just want to tell you all thank you for the time, and it's been an honor.
Thanks, Amy.
Thank you.
And Mr. Chairman, I'd just like to say we will miss you, Amy. You will be missed. So.
Yes, thank you, Amy. Anything from the staff, citizens? If not, it's 11 o'clock and we are adjourned.